January 16th, 2026. Silver closed yesterday at $91.52 an ounce. That's not a typo, $91. For context, 3 years ago, silver was trading at $23. It's up nearly 300% since then. And yet, if you pull up the stock chart of almost any major silver mining company right now, you'll see something that makes absolutely no sense. They're trading like silver never moved. Some of them are down year over year. Others are flat. A few have inched up maybe 15, 20%, while the metal they pull out of the ground has nearly quadrupled in value. This isn't a lag. This isn't the market being slow to react. This is a structural dislocation so extreme that it violates every basic principle of equity valuation. And the reason it's happening has nothing to do with geology or mining costs or jurisdiction risk. It has everything to do with a mechanism most investors don't even know exists. A mechanism that's about to break. Let me walk you through what happened yesterday. At 9:47 a.m. Eastern Time, silver dropped 3.8% in less than 10 minutes. No news, no Fed announcement, no geopolitical shock, just a sudden violent sell-off that looked like capitulation. Stop losses triggered. Algorithms piled on. Retail traders panicked. And then, within 90 minutes, it bounced back. Not slowly, not gradually, a V-shaped recovery that erased almost the entire move. Now, if you've traded equities for any length of time, you know what that means. That's not organic selling. That's not a market losing confidence. That's a shakeout. And here's where it gets interesting. While silver was getting hammered, the mining stocks barely moved. The Global X Silver Miners ETF, ticker SIL, opened down 1.1%. Silver dropped nearly 4 times as much. By midday, SIL had recovered almost everything. It closed the day down just 0.3%. That's what traders call relative strength. And relative strength in a beaten down sector, right before a major options expiration, is one of the most reliable signals of an impending move. So the question is, why? Why would the stocks of companies that produce silver show strength while silver itself gets crushed? And why does it matter that today is the third Friday of the month? Let me explain the mechanism. Every month, on the third Friday, options contracts expire. Billions of dollars in derivatives tied to commodities, equities, and indexes either print money or go to zero. This is called OPEX, options expiration. And in the world of precious metals, OPEX is when the paper market meets reality. Here's how it works. Large institutions, mostly banks, sell call options on silver and gold. A call option gives the buyer the right to purchase silver at a specific price, called the strike price. If silver closes above that strike price when the option expires, the seller of the option has to deliver. Either they deliver physical silver or they pay the difference in cash. Now, if you're a bank and you've sold thousands of call options at $90 and $95 strikes, and silver is sitting at $91, you have a problem. Because if silver stays above $90, or worse, if it climbs toward $95, all those options go in the money. And that means you're on the hook for potentially massive payouts. So what do? You defend the level. You use futures contracts, you use high-frequency trading algorithms, you use whatever tools you have to keep silver pinned below those strike prices until expiration. And that's exactly what we saw yesterday morning. That wasn't a natural market move. That was suppression. Now, before you think I'm spinning some grand conspiracy theory, let me be clear. This isn't speculation. The mechanics of options-driven price manipulation in commodities markets are well documented. In 2014, the Commodity Futures Trading Commission fined several major banks for manipulating precious metals prices through spoofing and layering fake orders. In 2020, JP Morgan paid nearly $1 billion in fines for similar conduct. This is public record. The tools exist, the incentives exist, and the behavior repeats every single month around OPEX. But here's the part that matters for you. While the banks are busy suppressing the price of silver to protect their options positions, they can't suppress the fundamentals of the companies that mine it, and that's where the opportunity is. Let me give you the math. The average all-in sustaining cost for a silver miner, meaning the total cost to pull an ounce of silver out of the ground, refine it, and bring it to market, is around $23 to $25 per ounce. That number includes labor, diesel, equipment, permits, royalties, everything. 3 years ago, when silver was trading at $23, these companies were barely breaking even. A miner with $23 AISC selling silver at $23 has zero profit margin. They're surviving, not thriving. But today, silver is at $91. Let's do the math on what that means for profitability. Profit margin equals price minus cost divided by price. At $23 silver with $23 AISC, the margin is zero. At $91 silver with $23 AISC, the margin is $68 divided by $91. That's a 75% profit margin. 75%. For context, Apple's profit margin is around 25%. Google's is 30%. Silver miners at current prices should be among the most profitable companies in the entire market. And yet their stock prices are flat, dead, pinned to the mat. This is what's called operating leverage, and it's the single most misunderstood concept in commodity investing. Let me explain it with a simple analogy. Imagine you run a lemonade stand. It costs you $1 to make a cup of lemonade. Lemons, sugar, water, labor, you sell it for $2. Your profit is $100 per cup. Now imagine there's a heat wave. Suddenly people are desperate for lemonade. The price jumps to $10 a cup. But your costs? Still $1. Lemons didn't get 10 times more expensive. Sugar didn't quintuple. Your costs are sticky. They adjust slowly. So now, instead of making $1 profit per cup, you're making $9. That's a 900% increase in profit from a 400% increase in price. That's operating leverage. And that's exactly what's happening with silver miners right now. Their costs have risen? Sure. Diesel is more expensive than it was 3 years ago. Labor costs have gone up, but they haven't tripled. Silver has. According to the most recent quarterly filings from major producers like Pan American Silver, Wheaton Precious Metals, and Hecla Mining, all-in sustaining costs have risen to somewhere between $25 and $28 per ounce. So let's use $28 as the high end. At $91 silver with $28 AISK, the profit margin is $63 divided by $91. That's 69%. And these companies are trading at valuations that imply silver is still at $30. Here's where it gets uncomfortable. If you go back and look at the last major silver bull market, 2010 to 2011, silver hit $48 an ounce. At that price, with AISK around $20 at the time, miners had roughly 58% profit margins, and the stocks went absolutely parabolic. Some of the major producers doubled in 6 months. Junior miners went up 300, 500, even 1,000%. Not over years, over months. Today, silver is at $91. Profit margins are higher than they were in 2011, and the stocks have barely moved. So why? Why hasn't the market repriced these companies to reflect the reality of their profitability? 3 reasons. First, narrative inertia. Right now, the dominant story in financial media is that inflation is under control, the Fed is winning, and precious metals are a relic of paranoid gold bugs. That narrative is sticky. It takes time to shift. And by the time it shifts, by the time CNBC starts running segments about the unexpected rally in mining stocks, the easy money has already been made. Second, institutional positioning. A lot of the big banks and hedge funds are short these stocks. They've been short for years. And here's the thing about being short. You create your own gravity. If you're short a stock at $15 and it starts climbing toward $20, you have 2 choices. You can cover your position, take the loss, and move on. Or you can double down. Add to your short. Fight the tape. Most traders choose the second option. They throw good money after bad, hoping the price comes back down. And in doing so, they create even more explosive upside when they're finally forced to cover. Third, the media blackout. Precious metals are boring right now. They don't have a charismatic CEO doing podcasts. They don't have a Reddit army pumping the stocks with rocket emojis. So the financial media ignores them until they can't anymore. Until the move is so obvious, so undeniable that they have to cover it. And by then, it's too late for the average viewer to get in at a good price. Now, let me address the skeptics. Because I know what you're thinking. If this is such an obvious opportunity, why hasn't everyone already piled in? And what about all the risks? Let's go through them. The bears will tell you that inflation in diesel, labor, and equipment is eating all the profits. That these miners aren't actually making money because their costs have exploded right alongside the silver price. Here's the rebuttal. Yes, costs have risen. AISC has gone from around $20 3 years ago to $25 or $28 today. That's a 40% increase at most. Silver has gone from $23 to $91. That's a 295% increase. The margin expansion is objectively visible in the quarterly filings. Pan American Silver reported free cash flow of $186 million in their most recent quarter, up 340% year over year. Wheaton Precious Metals reported record operating cash flow. These companies are printing money. The math is right there in black and white. The fear that governments will tax the profits away. If silver goes to the moon, what's stopping Mexico or Peru from slapping a windfall tax on mining profits? Here's the thing. This fear is exactly why the stocks are so cheap. It's priced in. That's why the sector has been unloved for a decade. But here's what the skeptics miss. Governments are slow. By the time they've held the committee meetings, drafted the legislation, and passed the new tax code, the stock will have already doubled or tripled. That's the opportunity. The idea that JP Morgan or Goldman Sachs will manipulate the market forever to prevent silver miners from reflecting their true value. And look, I'm not naive. Price manipulation in precious metals markets is well documented. But even rigged games have limits. Even manipulated markets eventually break. Because at the end of the day, the physical market is real. Supply and demand are real. And when the paper market, the futures and options and ETFs, gets too disconnected from physical reality, something has to give. Let me give you some context on what's happening in the physical market right now. According to the Silver Institute's 2025 report, global silver demand hit a record 1.2 billion ounces last year. Industrial demand, driven by solar panels, electronics, and electric vehicles, accounted for 650 million ounces. Investment demand, driven by coins, bars, and ETFs, accounted for another 320 million ounces. Total supply from mining and recycling was just 1.05 billion ounces. That's a deficit of 150 million ounces, the fifth consecutive year of a supply deficit. And here's the kicker. Above ground inventories, the silver sitting in vaults and warehouses, have been drawn down to multi-decade lows. According to data from the London Bullion Market Association, silver inventories in London vaults have dropped 35% since 2022. COMEX warehouse stocks are at their lowest level since 2016. The physical market is tight. And yet the price action yesterday looked like there's a glut. That's the disconnect. So what happens next? Today is January 16th, third Friday. Monthly options expiration. There are massive open interest positions at the $90 and $95 strike prices. If silver holds above those levels into the close today, a lot of institutional players are going to be in serious pain. Here's what I expect. Volatility. You're going to see wild swings. You're going to see moves that don't make sense on the surface but make perfect sense when you understand the options positioning. And here's what I'm watching for. If the banks start to lose control of the $90 level, if we see sustained buying pressure that pushes silver toward $95, then the suppression mechanism breaks. And when it breaks fast. Because all those call options the banks sold go in the money, and that triggers a gamma squeeze, a forced buying event where dealers have to buy silver futures to hedge their exposure, which pushes the price higher, which forces more buying, which pushes the price even higher. It's a feedback loop, and there's no plan B for that scenario. Now, here's where the miners come in. Right now, they're being held underwater by the same mechanism suppressing silver, but they're showing relative strength. And relative strength in a suppressed sector, right before a major catalyst, is one of the most powerful setups in trading. If silver breaks out today, if it holds $95 or pushes toward $100, the miners will play catch-up. And when they catch up, they don't move in a straight line. They gap, they spike. They make up months of underperformance in a matter of days. Let me give you some historical context. In April 2011, silver hit $48. At that price, with AISC around $20, profit margins were roughly 58%. Over the next 3 months, the major silver miners rallied 80 to 120%. Junior miners, the smaller exploration companies, rallied 300 to 500%. Today, silver is at $91. Profit margins are even higher, and the stocks have barely moved. The catch-up hasn't happened yet. But when it does, it's going to be violent. Now, I'm not telling you what to do with your money. I'm not a financial advisor, but I am telling you what I'm watching. I'm watching the silver to SIL ratio. That's the ratio of the silver price to the mining ETF. If that ratio starts to compress, meaning the miners start moving faster than silver itself, that's the signal the decoupling has begun. I'm watching the dollar index. If the dollar weakens, that's rocket fuel for commodities. And I'm watching the tick-by-tick action at the $90 level. If silver holds $90 through the morning session today, if there's strong buying support every time we test that level, then I believe the suppression has failed. And if the banks lose control, if retail starts to wake up to this opportunity, if the algorithms flip from sell to buy, there's no second line of defense. Here's what most people get wrong about commodity cycles. They think the move happens when everyone's talking about it. They think the opportunity appears when CNBC starts running breathless segments about silver hitting new highs. But that's not how it works. The opportunity is right now, when nobody believes it, when the skeptics are loud, when the consensus is that precious metals are a boomer trade and the real money is in AI stocks or crypto or whatever the flavor of the month is. That's the accumulation phase. That's when the smart money positions. Let me zoom out for a second and talk about the bigger picture. Because this isn't just about silver miners. This is about a structural shift that's been building for years. We're in a very strange economic environment right now. Equity markets are near all-time highs. The S&P is pushing 6,000. And at the same time, gold is over $4,600. Silver is over $90. We've got simultaneous risk-on and risk-off assets performing well. What does that tell you? It tells you investors are hedging. They're not sure which way the wind is blowing, so they're buying everything. They're buying stocks because of FOMO, and they're buying precious metals because of fear. That's not a sustainable equilibrium. Something has to give.